paid to the tax authority. We saw that more the debt, less the work. Now question is, if that is the scenario, then go and increasing the debt. Where is the problem? In the previous section, we have seen that more the debt, less the work. That means company should go for 100% debt. The work will be the least. So this section is going to be discussing the pros and cons of increasing the debt. Definitely, debt. Once you are increasing the debt, it is giving you a interest tax shield. Because of the interest tax shield, your work is reducing. But at the same time, what are the other issues are coming? Costs of bankruptcy and financial distress. I'm sure you, all of you must have heard about these words like bankruptcy and financial distress. Once you are increasing more debt, there is a greater chance that firm will default on its debt obligations. Once you have debt, you have fixed interest obligation, which you might not meet. You might fail. A firm that has trouble meeting its debt obligation is under financial distress. The debt holders can drag you to the court under the Insolvency Act. In the appendix in this chapter, being provided the detailed Insolvency Act, the code. There are costs associated with bankruptcy. The bankruptcy and financial distress has cost. On one hand, you are reducing your work, increasing the debt. On the other hand, debt is increasing the bankruptcy provision and the financial distress. And bankruptcy and financial distress is attached with costs. What are the costs? They are known as direct cost and indirect cost. What are the direct costs of bankruptcy and financial distress? Each country has its own bankruptcy code, while they are having certain common factors. The process is still complex, time consuming, and costlier. Once your debt holders have moved to the court of law, then court will seize your operation and a professional will be appointed or hired, outside professional. He will take care of all the officer will take care of all the disposal of the assets, payment of the debt, all these process he will take care. You people will be kept out of the office. The board of directors, the managers, all will be, the company people will be out of the office. The creditors may also incur costs during the process because they may not get 100%. They might get a percentage of a part payment of their debt. So they also might incur cost. So all these things are only loss making. Average direct cost, from research it is found that average direct costs are 3 to 4% of the bankruptcy market value of total asset. So 3 to 4% loss normally generates in this process, the direct costs. And it is likely to be higher for companies and industries which vary from company to company and industry to industry. Now we will come to the indirect costs. Direct costs are directly involved with, an officer will be appointed, he will sell the assets. The assets might be sold at lesser value. Then from the proceed, he will make the payment of the liabilities. These are the direct cost involvement. There are indirect cost involvement in financial distress. What are they? Difficult to measure it is very difficult to measure accurately what is the indirect cost and to what extent it will go, and it will differ from industry to industry. Estimated indirect cost might be, the loss might be 10 to 20% of the value. So it is much more than the direct cost. Many indirect costs may be incurred even if the firm is not yet financial distress. You see, if it is directly, it is not in the financial distress, directly court order is not there, still indirect costs are there much before the direct cost. Simply it faces significant possibility that it may occur in future, that financial distress may come. What are the examples of indirect costs are? Loss of customers, loss of suppliers. No customer will like to deal with a company who is going to be bankrupt because the company might not provide the after sale service. No supplier will be ready to supply raw material to the bankrupt company because the bankrupt company might be closed anytime, the supplier might not get his money. Cost to employees. Employees might start leaving the job because the company is going to be bankrupt, so the key employees they might resign and they might switch their job. Fire sale of assets. This is the direct cost. Once an officer will be appointed, third party will be appointed, he will start selling the assets. And once, because he is in a hurry to sell the assets might be sold at a very low price, which is known as fire sale of assets. The assets will be sold at much lesser than the book value. So you have to create a trade-off theory. What is the trade-off theory? Value of levered farm will be maximum, optimum at the point when it is equal to value of unlevered farm plus present value of ITS. We have seen in the spreadsheet. Present value of ITS we have seen. And if it is 10 years bond, the total present value of ITS we have calculated. So the value of levered farm is equal to value of unlevered farm plus present value of ITS minus present value of financial distress cost. Direct cost, indirect cost all together, the present value of financial distress cost will be equal to the value of levered farm. So not only you have to see only ITS, you don't consider only the ITS. This is one side. The other side of the coin is financial distress cost or FDC. So ITS and FDC you have to compare and value of levered farm is equal to value of unlevered farm plus the ITS present value minus the FDC present value. And difference across farms, difference across industry, they differ with industry to industry. The optimum leverage is the debt increases, tax benefit of debt increases until interest expense exceeds the EBIT. Remember this. We have seen in the previous section that debt, once you increase the debt, WACC decrease. Up to that time it will happen. The tax benefit will come up to the time the interest expenses exceeds the EBIT. The moment interest expenses will exceed the EBIT, that's why in the financial statement analysis we have seen interest coverage ratio. Interest coverage ratio is equal to EBIT divided by interest. Once the interest expenses will be more than the EBIT amount, then your benefit will be converted into a loss. The probability of default and hence present value of the financial distress cost also increases once the interest increases the EBIT. Therefore, the benefit turns into a loss. The optimal level of debt D star occurs when the value of the levered farm is maximized. D star will be lower for farms with higher cost of financial distress. Therefore, in the hunkering of reducing the WACC, if you are going on increasing the debt, what will happen? Your financial distress cost will increase. That will reduce the D star. You can see here the green curve, it is the curve for levered curve for high distress cost, high distress farm. And the magenta line is talking about low distress farms. You can see the value of unlevered farm is increasing. The value is increasing. But in this process, if you are increasing and increasing the debt to get the increased value of levered value, then the curve will, after a point of time, it will go turn downward. It will turn downward sloping. And if it is a distress farm, it will turn downward sloping much before than the company having low distress farm or low distress cost companies. The trade-off theory helps to resolve two important facts about leverage. The presence, the presence of financial distress cost can explain why firms choose debt levels too low to fully exploit the interest tax yield. We have seen so many companies. In the previous company, we have seen, in the previous chapter, we have seen Facebook as completely unlevered company, right? And here also, and many companies, Apple, a very low amount of debt. Here also, we have seen ARM holding completely unlevered, 100% equity, no debt. Even Intel, so profitable company, 85% debt, equity, only 15% debt. This might be the reason. This might be the reason. So the reason might be that your debt might increase the kind of, yeah. This is the reason many of the companies they use the debt very judiciously, very carefully. They use too low debt to fully exploit the ITS. They don't want to increase the financial distress of the farm. Therefore, that it might be the first answer why farms use too low debt. Differences in the magnitude of financial distress cost and volatility of the cash flows can explain the difference in the use of leverage across industries. You can find companies they stop using debt once they find this debt is going to increase their distress, or it may increase their volatility. Then they stop using the debt, they use equity. Even though debt gives a very good benefit, like in 2 billion of issue, 309 million is the present value of the ITS. Still, companies use debt very carefully. So, additional consequences of leverage, agency cost, and information.